Welcome back to the deep dive. So if you were watching the markets on Tuesday, November 25th, you probably saw one of the strangest trading days we've had in a while.
It was completely dissonant.
Right. On one hand, you have global indices rallying hard, just, full of optimism. But then the tech sector, the AI leaders, they took a really surprising, serious hit.
And that split, that conflict is the entire story today. Your sources show a market that's basically battling two different realities at the same time.
So one side is this broad macro optimism.
Exactly. The belief that central banks are about to open the taps again. But on the other side, you have this very immediate, very high-stakes risk hitting the tech sector right where it hurts.
In their capital spending.
Precisely.
So our mission today is to dig into those two key forces. We're going to look at how corporate America managed to clear an exceptionally high earnings bar, and then detail what is maybe the single biggest structural risk right now, this economic data vacuum that's forcing the Fed to make decisions partially blind. Let's get into it.
Let's do it.
So the big positive catalyst, the thing that sent the wider market climbing, was this really dramatic, very sudden shift in expectations around the Federal Reserve.
It was a huge repricing. I mean, the consensus for a rate cut at the December FOMC meeting, it just surged.
A 25 basis point cut we're talking about.
That's the one. And the probability for that cut jumped from, what, about 50%?
Basically a coin flip.
A coin flip, yeah. And it jumped all the way to a market consensus of around 80, maybe even 85%. That's a massive shift in conviction.
And what triggered it? It wasn't just one thing, was it?
No, it was this coordinated set of dovish signals. You had influential Fed officials, Governor Waller, John Williams from the New York Fed, Mary Daly from San Francisco, all sort of guiding the market in that direction.
And then the data backed them up.
The data absolutely helped the narrative. The U.S. retail sales for September came in a little soft.
How soft?
It was only a 0.2% increase, which missed the forecast of 0.4%. And that kind of slowdown in consumer spending is exactly what the Fed wants to see before they, ease up.
Okay, so if the market is 80% sure we're getting a cut, I'd expect the bond market to be on fire, but the 10-year yield only slid about 3.6 basis points.
That's a really sharp observation.
Doesn't that feel like the bond market is still holding on to a big piece of skepticism?
I think it is. I mean, the bond market definitely rallied. The yield on the 10-year hit 4.002%, which is its lowest close since late October. So it's significant.
That 4% line is the big one, psychologically.
It's the huge psychological barrier. Getting below that suggests the tightening cycle is really fundamentally over. So the fact that we touched it but didn't decisively break through it, that tells you the skepticism is still there.
And this wasn't just a U.S. thing either. We were seeing this dovish tilt pretty much globally.
We were. You look at the Bank of England, they held their main rate at 4%, but it was a really tight 5-4 vote. Very close. And their committee even noted that the path for rate cuts is becoming an increasingly closer call. So that just signals this global alignment towards easing, which is, a powerful tailwind for risk assets everywhere.
So here's the paradox that I find really fascinating. You have aggressive rate cut odds, you have global central banks aligning, yields are sinking. It's the perfect recipe for risk on.
It should be.
But the U.S. dollar index, the DXY, still looks incredibly resilient. Why is global capital still clinging to the dollar when the Fed itself is signaling that it's about to ease?
And that resilience is the big cautionary note in all of this. The DXY, it dipped a bit, sure, 0.35%, but it's still firmly anchored above that critical 100 mark.
Which is a big deal.
It's a very big deal. And if you zoom out, that strength is supported by a 17-year structural uptrend. So it tells us that even if investors are hopeful, they are still deeply defensive. They see the dollar as the ultimate hedge against, persistent systemic risks out there.
So hope is high, but the positioning is still wary.
That's it, exactly.
And that dual reality, that macro hope versus micro wariness, was perfectly captured in how the U.S. stock indices split.
A tale of two markets on the same day.
For sure. The Dow Jones Industrials, it saw really robust strength. It was up, 730 points, led by cyclical names like Merck and Home Depot that love the idea of easier money.
But then you flip over to the tech-heavy NASDAQ 100. It was the clear underperformer, down 0.60%. That confirms a tactical rotation was happening in real time.
Capital was fleeing those high multiple tech names.
Right, and rotating into value and cyclicals.
And the specific trigger for that flight from tech was this shockwave that hit NVIDIA.
That was the catalyst. NVIDIA stock fell sharply after reports that Meta is negotiating this massive multi-billion-dollar deal to buy Google's tensor processing
The
units
TPUs.
for deployment way out in 2027.
No, I think the simple read is, oh, Google is building a competitor. That's bad for NVIDIA. But the deeper insight here seems to be less about a performance war and more about a financial one.
That is exactly the point. This isn't just about who has the fastest chip. The era of NVIDIA's uncontested dominance is being questioned, but the real takeaway here is that this has become a capital efficiency war.
A capital efficiency war. Explain that.
Well, the biggest customers, the hyperscalers like Meta, Google, Amazon, they are terrified of their enormous CapEx burden, just the sheer amount of money they have to spend.
And the fact that Meta is willing to spend billions on Google's alternative instead of just buying more of NVIDIA's dominant GPUs,
Yeah,
that's the signal.
that's the critical signal. It tells you how desperate they are to find cheaper proprietary alternatives to claw back some of that spending.
Can you just put that CapEx strain into perspective for us?
I mean, we'll get into the full numbers in a bit, but broadly, the biggest cloud companies are spending so much money that about $1 out of every 4 they collectively earn is going right back out the door just to build AI capacity.
A quarter of their revenue.
Quarter of their revenue. So when your costs are that high, you are actively looking for an escape route. And the market just realized NVIDIA's biggest customers are building that escape route.
Still, we have to keep perspective for you, the learner. Even with this kind of turbulence, the long game in AI hasn't really changed, has it?
Not at all. The underlying secular demand for AI is still incredibly robust. I mean, look at the last year. Even with all this volatility, you see winners like Palantir Technologies still up over 162%.
Wow.
Broadcom's up 138%. The demand is there. The question and the new risk is who ultimately powers that demand.
Right. Okay, let's talk about corporate resilience because that was the other big positive driving the broader market. Q3 earnings season was exceptional.
It really was.
How exceptional are we talking?
A phenomenal 82% of S&P 500 companies beat their earnings per share targets,
82%.
which is one of the highest beat rates recorded since the financial crisis back in 2009. These companies are adjusting to everything: tariffs, inflation, currency swings. Aggregate earnings growth was over 14% year over year. They cleared a very high bar.
Now, given how huge the Magnificent Seven are, I sort of assume they drive most of the growth. But what's the actual consequence of them driving about half of all S&P 500 earnings growth? Does that concentration make the market more fragile?
Oh, it creates enormous systemic risk. Because while they deliver the growth, they also drive that massive capital requirement we just talked about, the big 5 hyperscalers. Their CapEx is projected to go past $560 billion by 2027.
560 billion.
That kind of spending strains their free cash flow. It consumes almost 25% of their revenue. And that is why any competitive threat that jeopardizes the future return on that investment, like this Meta-Google TPU deal, causes such a violent market reaction.
So that's the story of massive scale and financial strain. But let's pivot to a completely different, much smaller story of resilience. One that shows where growth is truly insulated from all this macro uncertainty.
The defense supply chain.
Exactly.
It's a great contrast. If you look at a defense-oriented supply chain company like BOS, Better Online Solutions, it's a micro-cap example of tailored growth. Their management was so confident they just raised their full-year guidance to the high end.
And where is that insulated growth coming from?
It's directly fueled by rising global defense budgets and the expansion of the Israeli Defense Forces inventory. Their main division is about 90% defense-oriented. This is growth that just doesn't care about consumer spending dips or what the Fed is signaling.
And they're expanding, too.
They're expanding internationally,
Yeah.
specifically targeting India, which is becoming a global hub for specialized wire and connector assembly.
But their report also flagged a vulnerability that's inherent in doing business globally, even when sales are strong. And that's currency risk.
That's the critical insight here. Even a highly profitable, specialized business like this is struggling with global currency volatility. Their CEO noted that the U.S. dollar's move against the Israeli shekel created significant pressure on their income over just 6 months.
So they're forced to react.
They have to. They're making price adjustments just to keep up. It just shows that in this environment of dollar strength, no company, no matter how specialized its niche, is entirely immune from these huge global currency shifts.
Okay, let's shift gears now to the auto market, which seems to be hitting a bit of a speed bump. What are the latest forecasts telling us about U.S. new vehicle sales?
We're looking at a forecast decline of 7.8% year over year for November. The sales pace, what analysts call it the SAR, is projected at about 15.7 million.
And what's the primary drag?
It's the sharp cooling of demand for electric vehicles and plug-in hybrids.
That's surprising. I remember Q3 was the strongest quarter ever for EVs. What happened?
Well, that Q3 surge was driven by consumers rushing to buy before the federal $7,500 tax credit expired. Now that the credit's gone, sources are reporting that EV sales are collapsing.
Wow, so that's creating a drag on the whole auto market.
Exactly, and it's likely going to force average transaction prices lower. That consumer incentive cliff turned out to be very real.
Now, moving over to commodities, we saw a big move tied directly to the unwinding of geopolitical risk.
We did. Brent crude oil fell sharply, over 2.5%, right after reports of potential peace negotiations in the Russia-Ukraine conflict.
So it just instantly unwound that risk premium.
Instantly. It just reinforces that a big chunk of higher oil prices was directly tied to that instability premium. Any hope of de-escalation can just crash the price immediately.
And finally, gold. It held its strength, which suggests it's serving a kind of dual function in this environment.
It really is. Gold futures rose because they're benefiting from two separate things at the same time. First, the expectation of lower U.S. interest rates. That reduces the opportunity cost of holding gold, which doesn't pay a yield. But second, it's still playing its classic role as a safe haven against all this persistent geopolitical instability. So it's the perfect hedge against both policy risk and systemic global risk.
This has been a really complex deep dive. The macro environment clearly embraced the dovish signals from the Fed, especially after corporate America cleared such a high earnings bar.
That pushed the broader indices higher.
But the technology sector showed this immediate fragility. It's pivoted from being a pure growth story to this high-stakes capital efficiency battle where, suddenly, the cost of doing business is the main threat.
And we have to end by reminding you of the most crucial structural challenge that underpins all of this: the U.S. economic data vacuum.
Right. Because of the government shutdown, critical reports like the November CPI release are delayed until December 18th.
Which means the Federal Reserve is going into its key December 9th and 10th rate decision.
Relying on forward guidance and incomplete statistics to inform a market that has already priced in an 80% certainty for a rate cut.
And that raises a really important question for you, the learner, to think about. The Bank of England's own analysis suggests that when inflation is already high, above 3 or 4%, economic shocks can be amplified by sticky inflation expectations.
So, considering that global defense spending and massive AI capex are only increasing cost pressures, we have to ask you, does the market's current 80% certainty for a rate cut ignore the structural risks that might keep inflation persistently higher than the Fed anticipates? And what delayed report will shock the system the most when it finally drops?